the clarity of your vision and mission of why you're here and why you're actually investing or trading. I think what has happened, we've had created like more of a herd mentality in a lot of markets. We become more dependent on what Jim Cramer is going to say on TV, what Bloomberg News is doing, and what happens is basically we become a slave of that moment rather than having that independent and more unbiased as far as our own decision making. And that's my mission. I'm hoping that I will give you the tools that at least help you to build on that foundation. But of all the things, I think you should know who you are. You should know why you're actually investing in your 401k, or you're doing short-term investing, or any type of a vehicle that you're investing. What is the why of that? And it goes back to your personality. And we, as children, we've come up with our own limitations from either from parents, our environments, from family members to colleagues, from workspace. So what has happened, we have created our own biases. And the sooner you can find out who you are, I think the more successful you will be as an investor. I think by reading books and watching YouTubes, as good as they are, it's only maybe half the battle. The most important thing is about your understanding of, again, where you're coming from, what is your objectives, getting rid of some of the cobwebs in our past and some of the limitations. And that's one of the reasons some of the smartest people in the world are, unfortunately, at least financially, they're not very secure. On the other hand, some people that not even with a college education, they are thriving in their financial future and every other aspect of life. So it's basically, it's knowing who you are. And that's a key for success, in my opinion. There are actually some tests, trading and investing tests that, if you like, I can provide that tells you as your personality. And the other thing is you have to understand, while you understand your personality, that creates the way that to know whether you're a short-term trader, are you an investor, what is your, again, understanding of the markets. Do you want to, are you more of an analyst? You're more of a long-term, you like to do your own research. You'd like to be, that's what we call like do the fundamental analysis of, let's say, in stocks. And based on that, sometimes you're a perfectionist. You want to make sure everything is to the T. And what happens is then you're more of a long-term and you're actually an investor. For someone like me, that I've got both because I was a portfolio manager for 33 years, I had to do both. I mean, when I'm managing the client's accounts, I had to have long-term view as well as a short-term view. But as a trader, my biggest asset is the decision making. I have to make quick decisions, whether right or wrong, and I have to accept my consequences. So I am very visually oriented, and basically what happens by seeing and seeing the patterns, that's when I make my decisions. My goal is, and it goes back to your mission and vision, is obviously I want to make sure that I make money because that's the objective of investing. But also I want to make sure I learn from my mistakes and I try not to repeat that again. And one important thing is money is really, it's almost, most of you know, I love soccer, and although money is that goal that we score, it's the process which is the most important thing. It's the process that we have to go through and find out that what we are built up. And that's where the joy is. And this is where, again, I'm hoping by going through this, maybe we can help to learn the techniques, but then you really have to start applying those techniques to become skills. And based on that, then you become a successful either trader or investor or both. And basically continuing that process, the goals will come, which is really your money. So the money should not be your first thing. And I use, again, soccer terminology. Yeah, you can score with toeing and shooting with your toes. It will give you, but is this the right foundation? Is this the right technique to do that? So the idea is, right, learning the right skills, techniques, and then making them the right skills, and then achieving your goals. And again, it all depends on personality. For someone who is, again, very analytical, what type of an instrument will be helpful for that person? Again, for someone who I'm a trader, I do almost everything. And so futures market are very fast paced, but because I make quick decisions, that's the right market for me. I love options because I have a mathematical background. I like to analyze things. It's more, believe it or not, more probability and mathematically oriented. I enjoy options. Stocks depend. I mean, the environment that we are in, it has become more of a trading environment rather than an investing environment at this moment. And so stocks have become a very good tool for even short-term investing. Forex can be both, but I would say short-term and intermediate. Real estate, well, when you go back to 2010, 2011, probably became more of a trading, but as far as like investing, it is really more of a long-term investing. And we talk about bonds, Bitcoin, you just name it. I've invested in camel milk too. I mean, I've invested everything that moves. I had invested and I got some experience from farmland stocks actually to, again, my background is in international finance. So my goal is to find what is giving us the best return and best opportunity at this moment. But it's all up to you. It's your personality which dictates what instrument you should use. And that's what I think, again, the problem happens is that people actually try to be, again, dependent on most of the news. And it becomes a news-driven and event-driven when we're investing rather than having our own accountability, foundation of knowing why we have been doing this. And one of the best ways I found out, and I apply to this day, is I have a journal of things that I do. To be fair though, lately I don't actually write down because I do this short term, but mentally I know exactly why I got into a trade. I have a very clear vision. I know where my stop's gonna be, how much I want to do as far as money management, risk management. I know how much pain I can take, but what is my target? It's very much pre-planned, and I try not to deviate from that. So what happens, a lot of people start as a short-term trader and end up being an investor. Because now, let's say the markets go down, they start praying and they say, well, it will come back. So all of a sudden, all the discipline that they had at that moment goes out the window. And the main reason is because of the biases I mentioned in the beginning that we have. We have the representative biases, the things that we are familiar biases, the things that we have, the fear and hope. Those are the things that affect us. We have, as far as like the fallacies, that overconfidence. I mean, that's a big thing with the overconfidence. As a portfolio manager, and I'm working with a lot of other portfolio analysts, you have a lot of these people, sometimes they give a lot more credit to themselves than they should. And one of the problems I've had in the past with these people who come on CNBC or the portfolio managers, if they were so good, why 2008 happened? Why did 2000s, 2001s happen? Why we have the crashes? Why we have the bubbles? Because we should know, we should be prepared. The whole reason is because those advisors are human beings too. They have their own hang-ups. They have their own biases. They have their own personality shortcoming. So as much as they think they know, and unfortunately because of the herd mentality, what happens is it has a domino effect, and it ends up that, again, we have like crashes or the bubbles, and in either side, you can see we have the extremes. So basically, the hope is that by knowing what you know, by knowing who you are, then you will avoid all those shortcomings, as I mentioned, and try to make the decision that you're making is more of a sound one, because you have clear vision of why you are an investor or why you're a trader. I love history, and I think that the history does repeat itself because it goes back to the human psychology. And I just mentioned our biases. The main ones are actually the fear and greed. You go back to 5,000 years ago, you go back with all the technology that we have, our brain still functions the same way. Our needs are similar. The power, when you talk about politicians, you know, they had swords before they had cannons, now they have nuclear bombs, but their psychology is still the same. And that's why I think it's important to learn from our history. And one thing I should say, with all the challenges, again, with this environment that we are in, and then, as I mentioned, we are being challenged, the kids are bored at home. I think this is a fantastic opportune time to have our younger generation speaking to the older generations. Listen to those stories, because those human stories repeat themselves. And granted, we have the YouTubes and Facebooks and all the social media that, you know, puts us in touch, but the real connection is sharing our real stories, not one story which just goes around and retweets itself, and it goes on the Facebook and everybody sends through the Telegram or whatever instrument that they use, the media that they use. It's an absolutely fantastic time to learn from the experiences that our parents, grandparents, they've had, even our children. This is a fantastic time to talk to them. And one of the things, actually, this is an opportune time if they're interested, if you have children that they are getting out of college, they are getting the new careers, this is a time to share your experiences. If you did go to the dot-com crash, if you did see that financial crisis, because again, our human emotions haven't changed. In life, one of my friends, David Meltzer, who's, you know, if you're familiar with the Jerry Maguire movie with Tom Cruise, that was his life story with his associate. He says that our life, our days start with one action only, when we wake up. After that, everything we do is reaction. And that's where the mindset is. If you have the right mindset, then you can know, you can control that reaction. The markets are right. When it comes to investments, you cannot challenge that. It's not about what you think. You have to do what the markets are doing. So it's your reactions which are very important. Now, how we react, besides our personality, is having, again, more tools accessible to us. And that's what I mentioned about history. So what I did, I went back to dot-com crash. As dot-com obviously implies, it was really the technology. As I know some of you went through that. It was wonderful years in the 90s, which really started in the 80s, and 90s became really efficient technological improvements. And there were companies, I mean, talking about trading, people were trading stocks which would go up $100 in one day. And that's what it built, the false sense of security. So when the crash happened, it really took a lot of people by big surprise, because most of them, they had not seen it. Granted, we had the 1973, 1974, and then maybe 1987 crash, which was very short-lived, but they had not experienced any of those. So it caught them by surprise because life is good. And I remember, again, my taxi driver in London is giving me stock tips. And basically that was, for me, that was a warning sign, especially I'm a value investor, and that's when I started getting out of my accounts and started go into cash or leave in some just in the value investments. And so basically on that, if we can look at today's markets and we go back to, let's say, dot-com area and see what was the best performing sectors and what was the worst performing sectors. I start with the worst performing. As the dot-com indicates, obviously was technology stock. So it makes more sense that they were the biggest losers. We are down right now. The markets last time I looked at is like S&P is down 23.9% from March of 24th, 2000, which was a high, to 10/9/2002. The markets in technology, they dropped 81.9%. Next was the industrials, which makes sense. These are the really economic sensitive stocks, and they lost 36.3%, and utilities, they lost 35.8%. On the other hand, the best performing, and you will see a common denominator in these crashes and bubbles, are the consumer staples. And why is that? Because they're defensive sectors. They're the sector that people really need. It's the food, it's the beverages. I mean, I noticed, I think that I was at Bloomberg yesterday, drinking in alcohols has gone up average of 68%. Wine is up 75%, beer was like something like 66%. So people either smoke, drink, which is less smoking now, but they have to eat. So that's where the defensive stocks do well in the times of crisis. Healthcare, again, this is interesting, and you see the common theme. Healthcare was the second best performer, although it was down 17.2%, while in the healthcare in the financial crisis was down 38.3%. And sorry, I made a mistake. I suppose the worst performing was the materials. That was down 56.6%. I'm sorry, yeah, utilities is 35. I'm jumping ahead with financial crisis. And then materials were down 20.6. The financial crisis, again, as it indicates, October 9th, 2007 to March 9th, you can see the best performing, again, was consumer staples, healthcare, and utilities. On the other hand, as again, the name indicates, this was the financials who took the biggest burden. Again, it's very similar to technology, which is very interesting, 81.6%. And industrial and material. They did industrial, more economic sensitive materials are the base material, raw materials, from oil to anything with the mining. And that was, again, it was a big effect on, because it came from the housing, and then it affected the banking, and that's what's called financial crisis. So why we looking at the history is because, again, markets they do give us footprints. They give us the guidance, what could happen. I do remember, I mentioned about dot-com crash. I was getting people calling me, my clients calling me, giving me tips. This is 1999, 2000, you know, Ramin, why don't you do this? And right there, that was the euphoria, and that was the warning sign. And the same thing in financial crisis of 2007, when the hairdresser tells you, well, in Vegas, they're selling $1 million high-riser, like 3-bedroom, and it's a wonderful opportunity, you can go. That's a good indication. The other indications are actually internal. I remember in 2007, in July, I never forget that, it's like Senator Schumer came out and talked about IndyMac problems. This was July of 2007. Right there, you knew IndyMac, which did a lot of subprime mortgages. That was something that should have given us a little hesitation. And then after that, in September, what happened was there was money markets, which are supposed to be the safest instruments. Although they're fund of funds in a sense, short-term really papers, they went under $1, although it went for a few days. That was a panic of September in 2007. So that also gave us a heads up, something not bad is going to happen. I come back to what we went through in 2009, September, you go back September 17th, we had the repo problems when it went from 2% to 10% overnight. And repo is the repurchase agreements when the central banks, they give liquidity money for the banks in need to make sure they are, liquid and fluid. And that was, again, a heads up for me. So it made me cautious. But then there was just so much liquidity as far as money, a lot of buybacks that it held the markets up. But you did see the footprints again. So basically, now what I'm trying to see is if you were back in 2008, 2009, and you saw what was happening, what would you do? And I'm trying to transfer that knowledge in the sense of understanding what to look for to see what we can do now. And I believe there's a lot of opportunities. I mean, a lot of people, obviously, the markets indicate to us that the 2000s were the lost decade. 2010, well, started March of 2009 to end of 2019. It was fantastic for stock markets. Again, equity was the name of the game, but interest rates are being so low. The commodities, which I will talk about, being really unattractive. So the real estate did well. Emerging markets, international markets didn't do as well. And what happened was a lot of even some of the similar markets overseas still haven't gone back to the high of what they were in 2007. And while it took us a few years to get back to where we were, we bypassed it, and it was a great decade. But what is going to happen after that? What is going to happen in 2020 and on? And basically, this is where we have to, I'm hoping by looking at the history, we can see where we should go. One of the problems with the indexes, when you read, you have to remember people who got scared in 2008, beginning of 2009, and they sold their 401ks and any other investments, they really didn't get back into the markets for years. Average was like 2011 to 2012. So although it shows that S&P was up over 300% and change, really people's 401ks weren't up that much. So it goes back to our human psychology. We are late to sell and late to get in. So this is, again, my hope is that we can actually avoid that and hopefully find some opportunities and find out when is the right time. Again, markets will tell us, they give us some pointers as far as where would be the good time. So I went back again, I'm going back to the history. I looked at, from the commodities point of view, you're more familiar with stock markets, in 2008, S&P was down over 13.5%, NASDAQ was close to 50, and Russell 2000 the same way. But I looked at what is the commodities. What did we even have any winners? And you look back to 2008, believe it or not, coal was the number one, had a positive return of over 12%, and gold was up 5.77%. After that, every single commodity lost. And it was, I recall, it was the first time in history since the Great Depression that we had commodities and stock market lose at the same time with such a great extent. From top to bottom, I know the commodities lost 77% that year, because I remember that year very well. The good thing is, again, looking at the footprints, I remember October 10th was really the top of the markets. And because of what was going on October 31st, I started shorting the markets and I started buying inverse market ETFs as a hedge. And when I was managing clients' accounts, and that's why 2008 we stayed on the positive side, just because we could see some of the ideas that coming up as far as being defensive. But go back. Now, the interesting thing is, what you see that coal and gold being the big winners, and you look at lead, and we look at nickel, and then copper. What are they? Very much, obviously, economic sensitive, construction and building. And what happened? They were really demolished in a sense. But look what happened in 2009. The number one return was copper. I remember it, like December 2008, I looked at copper was $1.51. Companies like Freeport McMoRan began, we had the SQM from Chile. They were actually operating below, the cost was above the price of copper. So either they had to shut down or they had to stop really producing, and they would have just gone out of business. So what happened was, you knew you have a big value, because mining, once it stops, then this is all about supply and demand. So what happens if there's now the supply is really drying up, demand being more of a stable at that time, then the price will go up. And that's what happened to copper. And again, this is a history, so you can see the two worst ones, they were the two big winners. And the continue, and then coal was the worst performer. So one of the things that you will see that common in all of the crises that we've had, gold has been a place as far as the hedging goes. And that takes us to today. So I'm going back to history. One of the things that you probably hear a lot is the VIX, or the volatility index. Probably it was a foreign word a few years ago, although it's been around since 1992, 93 really, but nobody really followed it. In 1990s did nothing, it was very flat. And then we ended up seeing things, especially in 2008, 2007, and people paid attention, then they forgot about it again, and now they're paying attention again to it. Again, it's called fear gauge. And what it is that it's basically the volatility of 30-day or 31-day S&P, the big S&P actually contracts, which is their option premium is based on. So basically options really depend, the pricing depends on 5 things, but the main ones are obviously the exercise price, what the price are, and the intrinsic value. But the main thing is the time and the volatility. So what has happened, I went back to 2008, like you can see, this is October 2008. You will see it's like a very similar, we went over 85 at that time, it was October, November. Then we had a big collapse, and people said, oh, the markets will go up again. So you can see the markets dropped, and then we had a pretty nice bounce. It doesn't look that big here, but it was. And then the volatility had the second leg up. As people were getting comfortable, they thought because of all the stimulus package coming in, everything was approved. And that's when the third and fourth, all the stimulus packages were coming in. As you can see, then we hit the second leg down. Then volatility is now digesting itself. We went back to mid-30s. We had another jump in the volatility. But as volatility was going down, the markets actually started going down. So that's when the March happened. So my outlook is, and I bring it to today, for instance, this is where we are. This is almost, for me, is October, November of 2008. And this is where we are. We had this nice bounce. We have the drop in the VIX. So what is the next thing? And I think what is happening right now is with a lot of uncertainty, and now, as you know, markets don't like uncertainty. What is happening, people are still hesitant. We don't have the euphoria of the 2000s. We don't have the devastation, in a sense, of the 2008, 2009. but we have this uncertainty. So the way I look at this is, I mentioned again 2000, 2001, we had again with the technology, that was a bubble, because you would see, and I know some of you would remember, 18-year-old high school graduate says, Dad, I don't want to go to college. I just want to go get an internet company, take it public, and I'm going to make multi-million, but I'm going to make $1 million a year. This was actually the thoughts of 18-year-olds. And you fast forward to 2007, 2008, it was at real estate. So the first one was the technological. The second one was really, it was the top down. It was more of a macro environment. It was the banking and the financial system which crashed. So it came from top and hit average person and small businesses and businesses and individuals. The difference this time is we started with the healthcare, which affects everyone. It's a health issue. So it's not discriminatory. We don't know what's going to happen next. We think, we will have a better understanding maybe next month from now, but we're shooting in the dark right now. What that has affected is the small businesses. So right now, this is almost bottom up. And because of the bottom up, we don't know how it's going to affect, again, the individuals completely. And that's why I think, again, the central banks around the world, they started printing the money. Obviously, you're talking about footprints. When the first week of March, when our Fed chairman, Powell, comes and just completely, in a sense, brought 1 percentage point of the rates down, you knew it was something serious. And that gave us, again, a heads up that they thought this is not something just going to go away in a short time. So what happened was, at that time, again, because of unknown, there was some hope. And that's what you see, these glitches of hope. We go up, staircase, come down, we go up. So my thoughts are, again, because of that uncertainty, and because this is the small business problem and individual problem, the only time I will know and I will be more aggressive towards the market is when I see the stability in our small cap markets, small business markets, which is our Russell 2000, for instance. We will look at the IWM, which is the exchange traded fund for that. So again, I go back, you can see this is what the history has told us. Would we repeat? I don't know, but at least I have a footprint, in a sense. I have a model to be prepared. So if we are here, are we here? Are we gonna have another leg down? And I would tell you, you've got to be patient in these environments. Now, if you have already sold, let's say your 401k, you're out, well, I will be on the sideline, but I would dip, just nibble in. But this goes back to my initial thing. You have to know what is your purpose to buy a stock. If your stock goes up 50% in 3 days or 4 days, you don't need to wait. That greed shouldn't kick in thinking that you're going to go up 70%. At least take some profits. And this environment has given us that opportunity. I will share some of my trades. Believe it or not, 90% of my trades for the month of March, they haven't been short selling. It's been more of almost buying puts all the time, because the premiums on the puts they've been pretty expensive, except now it's coming down a little. But it's been actually, even on longs, I'm buying stocks that they've gone up in a day or they've gone in hours, and I'm not greedy. I know what my discipline is, and I know I want to stick with it, and I make the profits. So talking about that, I like to share anatomy of an option trade I did this past week, and maybe it gives you a little better understanding where I'm coming from. So this is Monday afternoon. As you recall, the markets had after Friday's debacle, last Friday we had a big drop, and then Monday comes and if we have a big bounce, and now we'll show you what the S&P did. So right around here. So this is Monday's market. Right around here at 12:43, I ended up buying a put options. It's a weekly. It's only 2 days, believe it or not. It was expired on April 1st. So basically, I was betting that S&P is going to go down by Wednesday, right around here. So this is Tuesday. This is Wednesday. And that was my bet. So I will review why I was making that bet. And this is the result of my trade. So I always like to buy multiple contracts. Whatever I do, could be stocks, futures, options. And the reason is I like to have that flexibility to get out of my contracts, the discipline that I have, one at a time. So I go all in and I get out on stages. So this is what happened. 12:43, I buy this put options, which was was a spike to 60, put 60 April 1st. And then the next day, I got out toward the end, right around here, and I think we were up 28, 30%. My goal is, my first goal in options is 25%. That's my objective. So my goal is 25, 50, 100, and the last quarter is a runner. I will put the trailing stop. My stop loss is 50% most of the time. This one was such a short term that I just went with my gut. And I mentioned about journal, and I said, please write it down. When you get, I've been doing this for 35 years. My journal is almost on my mind. I mean, I know in my mind, I do take pictures of my trades. Sometimes I make notes, but I always make mental notes. And I've learned over the years, it's just, most of you played sports, in soccer. I mean, when you shoot the ball, you don't think about how I'm going to position myself, the knee over the ball, the, planting foot where it's going to be. You just do it. And this is what has happened. And I'm hoping you will build these habits so it will happen. And so on Wednesday morning, as soon as it opened, I had already put a target day before, and it hit my target at 12 and change. So I bought about 460, sold it at 12 and 20 or something. As you can see, it did finish at close to 15, but I have no regrets because I stuck to my discipline. So let's go and see why I was pretty comfortable taking this weekly put option. Two reasons. Number one, again, I looked at the big picture. I was looking at the VIX, but this trade went on Monday. Mondays are not a very good indicator of what is going to happen to the markets. So one lesson, I'm not a big believer on Mondays. Mondays are more news-driven, event-driven, what happens overseas. We haven't had time to digest all the news. A lot of bad news or good news, and most of the time bad news. If you notice, if the governments have bad things, they come after like Friday afternoon, when used to be people would go on their weekend. They don't really care about the news. Sunday night comes, they already had forgotten about that. It's a new news. Old days in 1980s and 1990s, if you recall Wall Street Week with Louis Rukeyser, which is my favorite program. It was the #1 public PBS TV show. They would have all the news. They would have their guests come in and they will look at what they were buying. So Monday morning comes. There was a Barron's effect on Monday morning when the Saturday news came out. So Mondays are very much a reactionary. So that's why we have old saying is call it turnaround Tuesday. So what happens is Tuesdays usually fade whatever happened on Monday. And not every time, but when there's a big movement on Mondays, usually you will see the opposite on Tuesday. Again, 80% of the time I would say. So I'm pretty aware of that, and that was my main reason. So that's another reason I don't trade much on Mondays as far as like buying or selling. I did buy the put up because I just want fade. I play maybe futures on these days. Most of the my trading is Tuesday, Wednesday, and Thursday. Fridays, again, you want to be careful because it is all about what's going to happen over the weekend. So a lot of people, they wait, they want to see what's going to happen, so they close their positions. And the institutions, I try not to trade after 12:30, 12:20, definitely not after 12:52, because especially in the futures market, a lot of retail investors who've been hoping and hoping, and maybe they were shorting the market. If you notice, right around the last hour and the last 10 minutes, they just give up. They say, oh, they cover their shorts, and institutions take advantage of that. So every day, it's like the last hour, especially the last 40 minutes, is institutionals investing. So I will let them have a ball. I'm not going to be part of that. So anyway, so that was anatomy of my option trade. Every week, I like to share a website that's free, and I believe it gives a lot of value. And this, I love this Finviz, which once we, after our presentation, I will share that with you. Oops. So, like you can see, Finviz is fantastic. I mean, we should have just a whole month of class on how to take advantage of understanding Finviz. Stock Charts is another free site, fantastic for technical analysis, for internals, is an excellent tool. Guru Focus, we've talked in the past classes. It gives you what is happening with the institutional investors, the hedge fund managers, what are they buying. It gives you the valuation. It gives you what is as far as like a Z-score or F-score, what's gonna, as far as the odds of bankruptcy, the solvency. It's a great site. Investors.com is Investor Business Daily. I was since 1985. I never subscribed to Wall Street Journal. I love Investors Business Daily. They don't have papers anymore, but you can still have access to their website. Last week, we talked about OneStock1.com. It gives you the historical returns of almost, first of all, almost every index, major index around the world. So you know what happened in 1991 in China. What was the return? What was 92? How did Microsoft do in 1988, 1989 when they were, just building up, and what happened to Apples of the world? So it's an excellent website. The last one, this is the one today I like to go over. It's called Forex Factory, and forexfactory.com is, and we will discuss more, it tells you all the economic news around the world that you will expect to come, and it's all about currencies. If you think stock market is big, stock market is the baby. Equity market is the baby of all the other markets. So the largest markets in the world is Forex, or the currency exchanges. Those are the ones who dictate everything else. After that, you will see the bond market and real estate market, options market. At the end is the equity market. So equity markets are exotic, and a lot of people know about this, but also the futures market are bigger than these. So really, the equities are the smallest markets. The biggest market is the Forex, and this is an excellent tool. If it's usually look at it on Sunday, so I know for the whole week what is the calendar, what to expect. Unfortunately, or unfortunately, we are so wrapped up with this COVID-19 that these are taking this, the back importance as far as as priorities. But it is a fantastic, and I will discuss that a little later. We talked about gold, that in times of crisis, how they actually become a hedge. So I thought to share with you what the gold had done, and so you can take your own conclusions and what to look for in the 2020s, for instance. Now, the gold, as you know, it's the keeper of the value. Basically, if you go back 5,000 years ago and just adjust it for inflation, If you go back 200 years ago, adjust for inflation, the gold has kept its value exactly the same. What I mean by that, a $1 of gold in 1800 is worth $1 of gold today, give and take. I mean, sometimes when you have a big moves, but the gold is really basically holds your value. On the other hand, the dollar is like gone down from, if you had a $10,000 in 1800s, it's down to $1. So paper money doesn't hold this value. So I thought 1970s, remember the inflation of the 1970s, and then the Hunt brothers in 1980. So what has happened in 1970s, gold was up 1,365.4%. 1980s, now it comes, the interest rates are going down. I know initially we had the recession, interest rates are going down, and then the bull market in real estate, and then also in equities started. So the gold was not really needed. There was no hedging needed. The same thing, roaring 1990s. Those 2 years, you could see, I mean, 2 decades, you could see the market, the gold didn't do anything. And believe it or not, I've been accumulating gold and silver since 1980. I've been collecting collectibles since 1986. So they were tough 2 decades. And then 2000 comes. Unfortunately, 9/11 happened. And at that time, you could see the rush to security went. And then, as you could see, that 2000, the stock market did nothing. So, and then now we are in 2010s. And so far, as you can see, well, as of 2019, December 2019, with 10-year return, this is a total return, by the way, not average or annual, you would have made 38% on your investment in the 2010s. So what is happening now, you can see the two big rush for the hedging is obviously the dollar, or the three, I would say, bonds. The currencies are dollar and yen, bonds, and also gold has been hedging. Now, the question is gold overvalued? Are you using gold as an investment? Do you do mining stocks? Do you do, what is it as far as the valuation? Now, and how is it related to, what about silver? What about platinum? And is this a good value as far as holding just gold, or should we look into some silver? And as you know, silver and platinum, they are more industrial oriented. So the silver, for instance, like 50%, the autos, the phones, the other dental usage, they all used to be actually more in dental, but not that much anymore. So they're more of industrial. So silver is always a little sister of gold. But I went back to the history, and this goes back to 1918. And interesting, it was end of the World War I, but also the pandemic, the Spanish pandemic, the influenza that we had at the end of, which ended then. So I looked at what was the ratio of gold. And the markets, they like normalcy. So we go from overvalue to undervalue. And then, I mean, these are decades. So we can see from 1918. So it used to be almost 30, almost 40, like 38. And now we are back to the highest we've ever been. So if you believe gold is the way to go in 2020 decade, silver might be a good alternative. If you, that's called poor man's gold. So this was just historical. Again, I also look at the ratio. This is from stockcharts.com, the gold oil ratio. When there's, this is gold relative. So there was one, and then we went really expensive, and then you can see it kind of adjusts itself. The gold didn't go down, but the oil was like really stretched, was like really undervalued. And that's when the news came. And we will talk about gold, whether it has legs or not. I also thought, this is from Finviz, you have access to it. And basically, on this one, it shows year to date, as of April 3rd, what is the best returns as far as all the futures assets. And you can see VIX volatility is up 207%. So assets were up is 30-year bond, orange juice, palladium, rough rice, 10-year note, gold, 5-year note, the dollar, 2-year note, and Japanese yen. And then the worst, obviously, it's been the Reebok gas, which is your gasoline, the oil, crude oil, Brent, heating oil, ethanol, and so on. I mean, but this is the important one I emphasize, the Russell 2000, which is down 37.1%. I'll go a little quicker. So the dollar is the key. If you want to see there's some stability, the dollar is really up because of the default, because all the other currencies are such a bad currencies. And as long as the dollar is strong, emerging markets are hurting because they have all their leverage, all their borrowing is in dollar. So stronger dollar is hurting them. So eventually, once the dollar comes down, I think the opportunities will be overseas. They will be more in emerging markets. And that's what I would look at, some of the value in Pacific Asia, and some there's some, again, emerging, even I've looked at in some, not too many in Latin America, but there is some that, but majority are in the Pacific Asia, I find. So this is just, again, I'm asking you to take a look at it yourself, see what is happening with the dollar. As you could see, we went and we hit our 50-day moving average, which is the average for the last 50 period or 50 days, and it bounced back. So the markets went up as dollar was going down. Now markets came down as the dollar is going up. The same thing as far as the sentiment. I look at the sentiment. I look at how many stocks of S&P 500 are under their 200-day moving average, or over, actually 200-day moving average. So you could see up to even from when we hit the all-time high in February, we actually hit the majority of the stocks were hitting their highest, 90% were close to their, above their 200-day moving average. That would have given you a warning sign that we are getting really overheated. On the other hand, if you recall the last week, then the market had that the previous week when we had over 15% market bounce back up, we were really oversold. There was like hardly any stock was over their 200-day moving average, and there's only 9% of them. We're still gonna need to digest this. That doesn't mean we are oversold. So I'm not seeing, we're just getting kind of a digestive time. But once it starts going and breaking above this, then I would be buying into this. But right now, I'm not convinced that we're done. The other thing I would like to share is that the Baltic Dry Index, and basically it's that it's not an index you cannot buy and sell, but it shows the shipping activities for dry goods. And you could see where we were, this red line, as the markets were actually going up. Remember, we had this was actually selling off, or that was getting lower. It was giving us a heads up that the global economic activities are very, very low. Now, we have come back up gradually, but we are flattening. So, but this is a good indicator if you want to, I'm hoping I will have, by the way, the PDF of this presentation so you can actually have access to all these symbols. And but right now we are flattening. So I like to see once this goes up, then I will be convinced that economy is in a healing position. Copper, they call Dr. Copper. Basically, they're the leading indicator on economic activities. Again, it could tell you that where we were, over $3, actually over $4 is a healthy economy, global economy around the world. So that's when the expansion is. Under 3, basically, then we are really hurting economically. And this all started with China. As you know, China was 50% purchaser of the copper of the world. They have really changed their sentiment before even all of this. But as you can see in January, when the the news really got public about Wuhan and all the COVID, this was has happened to the copper. So this is again a good indicator of what to look for as far as if there's any type of a recovery going on and what the stocks are gonna, whether the stocks will follow the economy. I also look at lumber. Lumber is again the health of economy with the real estate and activities. And again, this tells us in February where we were, where we are now. And by the way, you have access to lumber through stock charts, as well as you can have access to it with Finviz. The last but not least, and we will take a little pause. I had a question last, so as you know, the last 2 days, the oil just went from $20 to $29. So the question was, there was a sell-off actually in the energy sector, which is the XLE. There was a question why oil went up on Friday, still going up, but the energy stocks are going down. So there's a couple of answers, and this applies to the gold and the mining stocks. Mining stocks are usually a leading indicator for gold when they are really oversold. That we had it in December of 2017, for instance. It was down 74% down. So that was a good time to buy Nugget or GDX, for instance. And then the gold had its move. The same thing here. So as you can see, I look at the relative of what was the energy sector compared to oil. The week before, look what happened. When we had that big week, it was the energy sector, which was really oversold. They were almost went to the 7 ratio compared to USO, which is by the way, is the ETF for our United States oil, which is the WTIC. So that they were already predicting that the oil prices could go up, and they were the most oversold sector besides financials. And now we are cleaning that. That's why the oil prices went up and the energy prices didn't go as much as they should have. And that's when on Thursday, and I will share that with you, I sold a lot of my holdings in, let's say, British Petroleum. I had the XLE. I had EC, which is a Colombian oil company. I'm waiting for the next leg down to go back and purchase when the right time comes. With that in mind, this is my presentation as far as the talking about the history. And what I like to do is I'm gonna stop and then share. Let's see how we do. All right. I'm gonna share the Forex Factory site. And that is, as I mentioned, just Google it, and then once you go to, by the way, everybody, I hope seeing it. So I don't want to, Sean, please just let me know if you're not seeing it, but I hope you're sharing it.
Well, currently I'm not seeing your desktop.
Oh, you don't?
Nope.
Oh, okay. Share screen. Oh, yes, you're right. So let me, how about now?
Yep.
Sean, can you see? Okay, so let me go back, start all over again. It's like, so this is Forex Factory. Just Google it, and then once you press it, it takes you to their site. And what it does, again, it tells you all about the currencies. But the best thing about it that I really like, it tells you every single event in the major economies around the world, and they put colors. So obviously red is the most important, yellow is not as important, but it tells you any upcoming news. That's a Sunday night, for instance, what's going to happen. In this case, well, President Trump speaking, but then talks about like Swiss franc, what is happening in euro, all the economic news. And based on that, you can plan your week and day. As I mentioned, the currencies are the key to everything else. So if you know, you understand your currencies, it will be, you don't have to trade them. You don't have to be a Forex trader, but understanding that what is happening to euro, what is happening to yen, and yen is a risk off. Basically, that means when there's worries, people park their money in Japanese yen, and right now is the US dollar, because it's the value that they can see. As we cut our rates, everywhere else cut their rates, so I don't see US dollar is going to go up, go down soon. But for trading and everything else, it is eventually, I think that the administration and maybe central bank, they're going to intervene. I give you one example, for instance, why it is important for the dollar to not to be manipulated, but to be adjusted is, as you know, with this trade war, what started with China, soybean, it was corn, soybean, it was wheat, the trade that we had, and President Trump came and said, oh, we got this deal with Chinese, and you could see that soybean prices went up. Well, today when you look at soybean prices, and then you will see that on Finviz, you can follow that. This soybean prices have come down for obviously for a couple of main reasons. One is the supply. We've had a very good weather, and so we have tons of supplies in the United States. But our competitors in Brazil, they have even bigger supplies. On top of that, real, which is their currency, it's been just hammered compared to dollar. Now, if I'm China, would I go to strong dollar and buy soybean from the United States? Or would I go to Brazil and buy their cheap real ample soybeans? So that's how you can see all these, the currencies become a very influential decision-making for the trades. So I just thought, just again, every week I like to share with you something that you could take back. With that in mind, I'm gonna share. Okay. Let's see. Now, can you see my TradeStation? Sean, can you see that? Okay. So again, I'll go back to the history. I go back, this is 1929, and this is 2009 and 2008. Again, what happened in 1929? We compare this, as you hear, we had the fastest drop in the history as far as the way the market went from the top to low in February and March, from February to March, and we compare it to 1929. So I've mentioned it before, we will have ferocious rallies in these bear markets, and we've done it in 1929 and we went, but eventually we had breakdown of the low of what we had in 1929. The same thing happened. I went back to 2008, 2009. As you can see, we had 1, 2, 3, and we finally broke down. And then this is the March 9th and 2009 when we went from it was S&P was 6666. In the Dow Jones was 6,700 something. And then we had this fantastic rally. So what I've done every week, we go back and we look at the Fibonacci numbers, which is gives us a little better indication of where we stand. And for me, the biggest thing is this Russell 2000. Russell 2000 gave us a guideline, and I've mentioned it before. We made the all-time high in Russell 2000 around October, when everything else in February was hitting. S&P, Dow Jones, and NASDAQ were hitting all-time high. We didn't even get close to that. So basically that was a divergent. And obviously it has been the biggest. We're down 37%. We were down more than that. This is our support. We hit the low of the 2016. We came back. We had a bounce that week. We are selling off again. So for me, in order to be convinced that this market has legs, and as I mentioned, we are not, it wasn't a big cap crush that we had in 2008. It was the big stocks which took us down. It's the small stocks are taking us down. And once I feel that they are actually comfortable pacing and we are in a good shape that we are moving up, then I will be more aggressive, start buying more, readjust. If you are out of the 401ks, if you're not, then I would just be patient. It's too late now to sell it. I would have another bounce, then I will sell a little bit, because I think once we have another bounce, we will eventually go down again. And then once we digest it, then we will move. One of the heads up again, why I'm convinced that we are not done with the selling, and it's not the best time still to get in. I would nibble in. I mean, you can put 10%. There's a lot of wonderful stocks out there that you could nibble in, but putting the money back in the markets, last week it was momentum stocks are still leading us. Apples of the world and big stocks that from Facebook and Google, they are not down as much as actual averages. So that gives me the basically the hesitation. So this is the S&P 500. As you can see, we hit the 38.2% retracement and we bounced back, but again, I'm not convinced we are out of woods yet. So those are the, and then on the other hand, you can see this is our 30-year bond. This is the monthly charts, and the central banks are just buying all the bonds that they can get. So to keep that liquidity there. And this is the Dow Jones averages. Again, we went inside this zone, we bounced back. Again, I'm not convinced. One of the suggestions, this is a strategy I would suggest, please have, I mean, this is a great time, and I'll show you a screen that how you can find some of the, and that goes back to the, let me go to let me share. Let me go back to. Okay. So everybody can see Finviz. Sean, can we see Finviz? Yeah. Okay, yeah. Brilliant. So with the Finviz, what I mentioned to you, this is a great, I mean, tool. You can have you can see the futures market, every single one. You can actually look at their performances, what they have done that day, what was the best for the week, what was best for the month to date, year to date. That's what I showed you. The Forex, again, the currencies, you can look at the crypto, which is the Bitcoin and Ethereum and, you know, just Litecoin, you know, all of those. One of the best ones are the groups, the sectors. What is the best sectors? You can see the performances and you can adjust it basically what is the best performing so far. As you can see, healthcare is #1. Then you can click on it and say, oh, there's 917 stocks in the healthcare. Well, let me see what is the best one so far this year. And it gives you all these. There's some small stocks, but the Codex, for instance, is related to COVID-19. So basically, there's a lot of biotech companies. You can actually limit it and say, well, I want stocks that they're over, let's say, okay, correct. over $5 or $10. I mean, this is a great screening tool, so it narrows it to half. What I wanted to show you is, let's look at the S&P 500, and then let's see what is the best stock so far in S&P 500. And this gives you how many stocks are there, and this gives you the basically the little screening tool that again, like Masons this is a brokerage asset management firm, and then we go to biotech and a lot of, so Gilead, for instance, Clorox, Netflix, Kroger, Camia. So basically, this is one of the best ways to actually analyze what is the best returns so far and what are the strongest. You could also look at the worst ones. Now, the reason I want to show you this is other thing you could do. You can see the exchange traded fund, do the same thing, and see with all this, what the markets have been going down, what are the biggest winners? TVIX is the volatility index, which is actually 2 times VIX. So you can actually kind of hedge if you're fully invested and you don't want to sell, maybe you could use some of these hedged basically instrument. You don't want to buy put options. So basically you could use either that, or there is a exchange traded fund called TAIL, and that basically would be something that it could protect you. There's another one called Swan, like a black swan, and that usually it has a call option on it, but I would rather have TAIL. Or you can do inverse funds like S&P and the SDS and TRD. So basically, it's a great tool for you to screen and play with it. I mentioned before, you can actually use countries if you want. What are the what is the best stocks in Asia? What is what are the companies in Brazil? Brazil has gotten really hammered. So performance-wise, what is the best stocks in Brazil, for instance, so far? So there are not many. I mean, that's funny. The worst, and they're still in red. All right. So with that in mind, I think I am done, and I'm ready for any questions. Just then I can share it with you. So go ahead and maybe I can see you now. All right, good. Okay. All right, Sean, I don't know if you want to do anyone wants to speak, or we can do basically can send us your questions.
Yeah, I think we can do the Q&A. So I'm going to try to unmute everyone.
Okay.
I didn't operate, so if you want to unmute yourself, you're welcome to go. And then, thank you, Ramin, for the wonderful presentation. I really love it. It's a very complete. It covers a lot of ground of the financial world today, and very practical. I will raise my first question,
sure.
if you don't mind. So I did say a lot of stocks that crashed down, and now it already bounced back to the level, almost to the level before this crisis. I don't know whether if there's a second leg going down, those stocks will be dragged down again, or those stocks are relatively safe.
No, can you give me one example, Sean? We can look at the chart together if you have, because if you look at, I mean, if I want to use Finviz so everybody has access to it. I mean, this is where, like, this is the index of Russell 2000. We hit that. Last week I mentioned about the 20-day moving average is crucial that is that we hit our head against it and we've bounced back every single one of the indexes. We always kiss that 20-day moving average. I mentioned moving averages are basically it's self-fulfilling prophecy, but we usually go and after we break it down, we go kiss it and then we break down again. And this is what has happened. So all the indexes so far, including the other indicator I look at is the Dow Jones Transportation. This is what happened. They're the leading indicator as well, that we hit that 20-day and we are going down. So I feel the way it's happening is we're probably gonna go to the low of the day. But if you have one stock in mind, I can actually look at that so everyone can follow. I mean, if there is any
I think previously I remember Chris mentioned the ZS, that's the cloud.
Good question. So that's only, okay, that's it. All right, well, in any adversity, there's always something that comes, and then I think the behavior of this change. And something with the iCloud, the security, I mentioned last time, I mentioned about cloud ETF. That's something maybe you can look at it. But ZS is, I actually even have it on Investor Business Daily. Now, this is a very special security company that it's really living on its own world. So basically you can see we hit the low of what it was. I mean, I had mentioned, I think when we had talked about, I thought 45 was a very good value to go in it. And to be fair, I did buy options on it. I did buy options, 50 options on it, and I covered it when it hit 61. So basically, this is because it has its own story. And even in the down days, it's still, so you're basically, what you have is the $70 or 69 is your resistance right now. So that's like an exception, because if you look at, let's say, Netflix, for instance, that's another, I mean, look at Netflix. So with everything going down, it has had a nice bounce, but again, we are hitting resistance even in Netflix. Amazon is another good indicator of what's happening. Granted, we came down all the way, but we have retraced a lot more than any other company, including like Facebook or Google. Amazon obviously is the benefactor of all the what's going on with the delivery and everything. So with all the material needed, and they're hiring people. So that, but they are very much exceptions, because if you notice about 91% of the stocks, which that's what the advanced decline tells us, they are down. So they're far in between. But eventually, like you're talking about Zoom video, for instance. I mean, look at what happened to Zoom, or GoToMeeting, which is the Citrix. Look at Citrix. This is the GoToMeeting stock. You would have never known there's a COVID. I mean, obviously they've been a factor of COVID, but never think there's any crisis going on. On the other hand, we look at, let's say, Exxon, and I will go look at Exxon where it was and what has happened. It is completely demolished. We did have a nice, this is called really oversold bounce. I don't think they're out of woods, but the dividends, people are still looking for, 8.88%, but Occidental started it. A lot of other companies will be following their footsteps, cutting their dividends. One last thing before I go to the next question is, as long as I answered your question, by the way, Sean, you feel free to ask more. But one of the questions is, I think that second week of April, which is next week, once the earnings come out, I think we will have, although still nobody knows, they're going to ignore whatever happened in the last quarter, but you could get a little bit of a guidance and see what the companies are doing. Basically, then I think you might have some sense of a little stability, and I think we'll see what happens, but we're still not there yet. Gradually it will start. Go ahead, Sean.
I just wondering whether the bounce back stock can be treated as like safe haven comparing to the stock still at the bottom?
So like something like ZS, you mean?
Yes,
Or
something like you just gave a couple of great examples, Amazon, ZS.
yeah, Amazon, again, they have their own story. So basically, let's compare Amazon with Microsoft. So you can see, and one of the best ways you will know the relative strength is you can see year to date, Microsoft is down 2.45%. So it still has strength. So that's good. On the other hand, you look at Disney, which is really affected. And I look at Disney's chart and look at year to date, they're down 35%. Now, would you buy Disney? And I'll share another technique, which I think I shared last week, was have a list of all the great stocks that you think they're going to be around in 5 years. Another one I will share with you, which is almost like an index fund, is Berkshire Hathaway. Buy one share of Berkshire Hathaway just because they have a wonderful annual the report. Just as long as Warren Buffett is alive and Charles Munger is, this is great.
Where's the price on that?
On Berkshire Hathaway,
Yeah,
is
is it on
178,
Literally right.
170. Do you see it or no?
Oh, yeah, I see it.
Yeah,
and
170.
And also, if you own a share, are you talking about going to that big convention or whatever gathering they have for the
Yeah, you could. I mean, if you can get in and if you can
Oh.
fly at that time. But yeah, you could. You're a shareholder.
Yeah.
So, but that's just wonderful to do that. The technique that I'm using, and I've used it. I mentioned I've done it for Disney. I did it for Micron. And now, would I, if I told you Disney's at $50, how many of you would buy that? Now, if there's a majority of you, but you say, well, it's at 93.88, what do I do? This might be, I'm not a big advocate of selling naked anything, naked puts, which that means you don't hold the actual stock and you say you sell like a covered call or in this case, naked put. But I am willing and I'm hoping to own Disney at $50. So I go ahead and I did buy June of June put option on Disney for $50. I collected $2.5560. So if it goes down to 50, I'm very happy to buy it at that. If it doesn't go, then I'm collecting my $2.65 premium. And I could do that all day long. I mean, I can just roll it and keep doing just one stock. If you have other stocks that you feel pretty comfortable that they will be, and Disney's problem is obviously it's theme parks, they have some cruise lines, but would Disney go below 50? And this is the one thing I forgot to say. Nowadays, everything you're looking at, don't look at daily, look at monthly. So as you can see, I mean, when I'm looking at Disney, $80 was when? 2014. $50 was about 2013. Is Disney that bad? I mean, basically you're looking at just their movie as like competing with Netflix. Apple is giving up. I think they gave all the rights away, so Disney is going to be a big benefactor. I don't know. I mean, these are the things that you have to think about. Other thing, I did this last week, and I could share that with you, is the oil, USO. I bought, so I sold naked puts on USO for $4 because I said I would be happy to own oil, and the USO is at $4, and oil was at $20 at that time. Well, I covered some of that, so basically I just covered the premium. So these are the things you should sit down and think, what are some of the things that you could have, and then either by, if you have enough capital, let me just explain one more thing, Chris, and then I'll add. So the capital, let's just say for Disney, what money you have to have in your account. So the common sense obviously says if you're buying the Disney 50 naked put every contract of put or any option is 100 shares. So 50 times 100, they want to have $5,000 in your account to be able to have that naked put option. Now, a lot of different ones that they allow you to have, if you have only 20% margin, which is $1,000, they still allow you to do that. So basically, you're taking a really low risk to have something like that. You collect the premium, you're like a landlord, really, you're collecting the rent. The other thing you could do, and that's what I'm saying right now, to have your bargains ready, is you can use LEAPs, which are the long-term options, and just go buy Disney for January of next year. If you feel that the stocks are going to go up by then, just go ahead and collect. I mean, just pay the lower premium. You don't have to buy Disney at 95. Buy the long-term option on it. Just have a collection. I think these are good times for solid companies to be able to nibble in. But as far as the market itself, I mean, I don't know, mutual funds are still there to buy the funds yet. I think we still got a little leg to go. And that's where the diversification comes in the picture. That's why when we looked at those commodities, I showed you the history. You want to have diverse. When the bonds did well in 2008, the gold did, so why not have some of that? And the next few years, I think that emerging and international funds are going to be better performer than our domestic markets. That's just my hunch. So, all right, long answer. Go ahead. Who's next?
How far did you go out on USO?
June. I went June. So one thing about naked put, I mean, once the volatility is high, when you sell it, there's a two advantage. Number one, obviously, you don't mind owning it anyway. It's a good price. It could go up. The other thing is, once the volatility contracts, your price of the put option goes down. So you collect, it's becoming more worthless. So your whole objective is to make sure that put option goes to zero. That's when you're buying it, when you're selling it, selling naked, anything. You just want to make sure that you just going to keep your premium. You're not going to lose it. So that's why you have to be careful when now that volatility is low. What is your prediction? Do you want to go lower? And that was one of the reasons when volatility was like at 70, 80, you had to be pretty careful on buying options, because if it contracts, then your premium, even though your direction was right, you felt that, well, it's going to go my way. But because the volatility was contracting, then you would have lost the premium from that. So if you're buying it. So, but anyway.
So
okay.
when you said you would go to LEAPs, you were saying you would buy LEAPs. Would you sell, or buy, I guess, sell a put in the LEAPs?
It's very long, so your premium is not going to go down as much, because again, remember, when you're selling, your whole objective is to collect that premium, and the time is your friend. So the shorter the time, the better, because as you know, the last 30 days is when the options lose the most value because of the time value. So basically, the reason I chose June was I looked at, and I was looking for the best spread between the bid and ask, because that's very important. Because when you sell it at bid, and when you buy it back, it's at ask. So you want to make sure you have a small spread. And June was the best for me, and it was like 2 or 3 months away. But anything more than that, your premium, unless really big drop, you're not going to collect as much. So I wouldn't sell put on a LEAP, for instance. Unless, I would roll it over. If you did it 2 or 3 months, I just keep rolling it. If it hits you, it hits you. If it doesn't, I just play it.
Okay. One other question I
Sure.
had, I was trying to look up the McClellan oscillator.
McClellan? Yes.
SNYMOT, I guess.
Okay.
When I tried in FinViz, I got no
it's
result.
thanks, Chris. That's great. So basically FinViz is more of a fundamental information, and it gives you basic charts. Stock charts gives you everything, and it's free. So I would definitely, stock charts is the way to go. You could even, as I said, I use the ratio. You can use exactly what I did. Everything comes from stock charts. So yeah, do that. That's the best. That's free. You're welcome. All right. Any other questions?
Well, I have a question. If you're not really deep in the market at all, in
Yes.
general, you know, if you don't have any money that you already don't want to lose because it's in the market, but you now just, is this a good time just to put money in the market, or are you still kind of being a little leery and watching it, you know?
So again, that goes back, what is your purpose? So if you are going to be in the short term and you find some bargains, and I've shared with you like my American Airline trade. So I got American Airline first thing in the morning at 12, got out at 15 in the afternoon. So I'm happy with that. If it went to $20 next day, I would not feel regret. I'm good with that. So this environment is giving you a lot more opportunity from a short-term trading way.
Oh,
if
for
you're
sure.
really, for sure, if you're in a really long term, you see 5 years, then you still, I would have a bargain. I would just, you know, I just nibble in. I would, let's say you have $5,000. I just use that as an example. And then you chose 10 stocks or 5 stocks. The beauty of this, we have no commissions, basically. So you can go to your TD Ameritrade or Fidelity or, you know, Charles Schwab, and then just buy one share. If you think, as I said, Disney, you don't want to play any options. Disney at $93. Okay, today I'm going to buy one. A week or 2 weeks down the road, I buy another one. And then you continue with that till you hit your 5 shares, which is 10% of your portfolio in Disney. So then in the meantime, maybe you want to be like Microsoft, or you have some healthcare. Johnson & Johnson, for instance, has done well. So you think that Gilead is going to come up with some breakthrough. So basically, or the iCloud, for instance, I still think that, or the securities. So you want to make sure, first of all, it's a diversified portfolio. It's not concentrated. But the way you look at it, let's say it's, again, at 5,000. The worst case, if you said the whole world collapsed, you lost 5,000. But the amount of information, the knowledge you get for this is tremendous. So you look at it as you paid 1 semester of college tuition. Just look at it that way, because you learn so much when you're psychologically involved in a trade. It's amazing how your reactions are completely different when you're just doing paper trade or you're just looking at things. You can read as many books as possible. It can be great for the next 10 years. That one win or one loss that you make, it teaches you a lot more than 10 books that you read. So it tells a lot about yourself rather than just the market.
Okay, great. Thank you, Rami.
You're welcome. Any other questions? I'm sorry, I hope I'm not holding you too long. It's like past our 90 minutes, but I'm happy to stay as long as you like. So, and I can go to
Ramin.
Yes, Ramsey.
Ramsey.
Okay.
Question for you. If Monday, the Saudis and Russia cut production, 10 million, whatever it is, do you think it's a good time to buy oil companies like Exxon, and do you think they will cut their dividends or not?
Good question. I think that the trend of cutting dividends has already started because there's just so much uncertainty. I mean, companies like Exxon and Chevron and a lot of majority of these companies, they need a $40 oil. I mean, they already gotten hurt. They have so many productions that are going around the world that they had to stop. It was funny. Apache on Friday, and I'll show you, came on Friday, and they had a great new oil field found. And I mean, look at where they are now. And they just there's just so much hemorrhage right now, and there's so much unknown that I would rather see a little. You've got to be very selective on the company. So I told you. So I own BP, the British Petroleum. I bought it about 1750, and I hold just a little bit. But that company, something like that, I want to look at. With the energy stocks, you definitely want to look at the smallest or the lowest leverage. Another company I mentioned is.
Like Apache, could that be a possibility of consolidation, that they'll be bought out by some?
It could be. That's one thing about these the companies, that you're going to see a lot more consolidation. But what the question you will have, though, is almost like you're hoping that will happen. It might not happen. But look at this Ecopetrol, which is a Colombian. This is a nice chart. I mean, once the oil started going up, it has been, once we had that oversold, and that's one of my holding. And the reason is, and this is, again, I look at the screening. So what you want to do, go to the screener here, and then you look at the energy sector, or you can go to the industry and look at the major oils, for instance, if that's your, sorry, just major. So just go to the major integrated oil and gas. So by going there, just look at the fundamental, the financials, and then find out which ones, look at the dividends. But I look at their debt, and I want to make sure they have as little debt as possible. And I look at their debt to equity. So that's how I look at their return on equity, for instance. I want to make sure it comes. So basically, then I decide. So you can see EC has the best return on equity, Total, and then, or even you can see the Royal Dutch. So you want to be very selective at this, because the idea is your outlook for the next year with the world economy, which is really oil depends on, is it gonna come back and how much? So on the other hand, we had this conversation. I think the countries like Iran, Iraq, Libya, you look at Venezuela, they're really hurting, and they're selling at any price. So whether it's under or over, they really need $60 oil. So there are like big powers might not mind hurting them. So I don't know. I'm just being a little political. So this, but as far as the energy sector, that's what I've become more of a trader. Unless they go to that, Exxon goes back to that like low 30s, I probably will watch it again and buy it maybe. But there's other companies that I think they're better situated than Exxon, in my opinion. Also watched S&P. This is another one of, this is the PetroChina, or the, I mean, that's a picture, the China Petroleum. And they've had a nice bounce back. And they're in China. And again, fundamentally, I just like to see that there's more greens in the valuation. So, and they still pay. So China supposedly is coming back faster than other economies right now. They're trying to tell us that their growth, first quarter growth, was above expectation. So, but anyway, is that does answer your question? The other thing is, the last thing I would say about this is, you can, that's what this ETF, the sectors are good. You can play XLE, for instance, which is compounds everything in it. I mean, I sold my shares a couple of days on Thursday, but you can see like companies like this, it just broke above the 20-day moving average. Let's see how it happens. If it stabilizes, then that might be a good time to go in too. So you got to play a little technical analysis here.
So
Okay.
Ramit,
Yes.
when I did a search on FinViz for the best major integrated oil and gas and the highest debt to equity, let's see, I got
No, you might get the lowest.
low debt to
Right.
equity.
I mean, you don't really, it's like you just go to the screen and then the screener and then just choose the industry, whatever industry it is. And then basically, I mean, let's say oil refineries, like let's say equipment services. And then this is what it comes out. So there's like 55 companies. Do you have time to go through them? No. So you can do it differently. You can either look at the performance, you can look at the ownership, you can look at the valuation, which ones are the like price to, well, let's say price to sales or price to free cash flow. And based on that, you find the cheapest, but also you want to make sure they're liquid. So, you know, 6,000 shares a day is not really a good company. So you can basically do, you know, like you can pick and choose. I mean, what I would recommend because of the time, I think if you all agree one day, or even this is like a whole month, we can have classes, and I'm thinking of doing a YouTube classes at how to use, let's say, FinViz or stock charts, because I think there's tremendous amount of information that you could choose. I mean, you could use, and then once you refine that, then you can go and find, start buying, and then you can use your Thinkorswim or you can use Charles Schwab, but you can start with this, and I will start at Sunday night. So
it was interesting because I was looking for the best oil and gas. So when you hit on that one, I had been looking at Chevron.
Yeah, CVX, right.
Yes, and so then when I noticed, when I did the went to the financials,
Right.
It showed that it had the highest debt to equity.
No, actually they're pretty low. They are like, at least this one shows. So it's pretty good. Again, you have to remember they have so many moving parts. They might, like Ramsey mentioned, there might be some consolidation. They might go and buy some of these companies, which will affect their earnings. So it could be a short-term, you know, setback. So it all depends how much cash they have on their hands. Are they going to use stocks? A lot of these companies, remember, part of the stimulus package was no buyback. So you know, when you look at 2019 and most of the major, you know, the bull run we've had, it's been basically because of the buybacks. These companies had so much cash that they've been buying back. And one of the things I will look at in this environment, if you look at insider transactions, that would be another telltale sign that what the insiders, especially if it's a CFO or CEO, is doing, then in this environment, if you have people that they really believe in their company and started buying, then that would be a really good telltale sign. Except there's one stock I tell you, I would not go buy that. It's called OPCO, which had a look at these. I mean, these are talk about the news. It was about they were going to do the vaccination. They came up with some ideas that they would be part of the government finding vaccination. So it was a beautiful movement. And then the CEO of the company, he is notorious about, he's buying his own shares he just keeps buying. His name is Dr. Philip. And he owns, this is 169 million shares, 186 million. So it has not been a good indicator. I mean, he buys 500,000. He kind of sometimes manipulates, but I mean, he owns almost everything. It's almost, the company should go private. But when you do insider transaction, just be leery of when somebody is doing it. And then you see at March 10th, again, he bought, and then one director bought. But he's notorious about buying his own stock. But if you find, okay, this is the last thing I say, because I'd like to hear you. I don't want to hold you up. one thing about these insiders, if you notice, and this Finviz gives you, as I said, we will talk about that. If insiders haven't done anything for years, or if they were seller, let's say 2 years ago, and now they're coming back and started buying, and especially as I mentioned, if it's a CFO, not just a CEO, if you see that thing, and Guru Focus will give that to also, besides this, that's a good time to really look into the company. So you can use the screen for the insider transaction. So, but that's besides the time. I mean, again, that would be another class on its own. So
We can
anyway,
do forever, Romain.
yeah, we can do. All right. So I know it's almost 4 o'clock. So I really appreciate it. I have some people from UK. I really think it's 12 o'clock in UK. Back east, I know it's dinner time almost. So I really, really, really appreciate you taking the time. I hope it was informative. I hope you got something out of it. Hopefully we can continue more. Most of you know my email address. Hopefully everyone knows. And just let me know. And with that in mind, if Sean, I'm at your services now. And if nobody else has any questions, maybe we can wrap it up.
One last question, just quick,
yes,
if you can
sure.
have an answer for it. With the Fed cutting rates to zero and a possibility going negative, I don't know if that's, if you see that coming in the future or not. What do you, is that a negative for the banks? Should we stay away from that?
Very good question again, because I don't know if you're going to see negative, because I think the Fed is going to use a different bullet. So right now they're buying the bonds. There was a suggestion of buying the equities maybe. So they are, the banks right now, and well, I'm going to another subject now. Let's look at the Bank of America. So if you recall, the 2008 debacle was really a banking problem. I mean, besides it was all the mortgage and the financial side. This time it's not. Right now, the banks, they have, hopefully they've learned their lessons. They really are not helping the economy in a sense because they're hoarding, but they're with this government, the stimulus package with the small business and other things. So hopefully that was enough that to give the banks the break. And that's what I will look at. XLF, which is the financial sector. I mentioned to you Russell 2000. I mentioned to you Dow Jones Transportation. And XLF will be my next indicator that we have turned the markets around. And as you can see, we are basically still under the 20, which is going down. So I would, I bought XLF right around here. I sold it. As I said, it was more of a trading. Once you see the stability in banking or an XLF, then that's a good time to start buying other things. So this is, but right now, the banks are not, their fundamentals haven't changed much. Basically, they still operating. It's the small and regional banks which will be the concern, especially again in southern states, especially like in Louisiana, Oklahoma, or Texas. Those are the ones who got their loans to obviously some of these shell companies. But other than that, I would sit tight and watch. I mean, choose some of the banks you always wanted to own. Some of the, from JPM to Goldman Sachs to Wells Fargo's of the world to, again, Bank America's of the world. But I don't think we're gonna see the negative because what is happening is that other countries, they're gonna go, they just undercutting us constantly. And basically that's the reason the dollar has stayed as strong as it should, because from the interest parity point of view, we have really low rates. So the dollar should be really low, but because compared to other currencies and compared to other interest rates, they're still higher. That's the reason dollar is still attracting the money. And also it's the security, right? So a lot of people, there was a question I know I've been asked many times, why would anyone invest in a negative yield? Well, the idea is that negative yield could get more negative, so that bonds will appreciate, but also it's the security of, if I have the bonds in German bonds and I feel I'm more secure with that than, let's say, in some other countries like the Italian or Spanish bonds, then I'm willing to get a negative. At least I know my money will be returned to me, compared to if I get 20% return and not knowing that I'm going to get that money. So that's the difference. But I would definitely watch XLF. That's a huge indicator of what the markets are when they're gonna turn around. And I still don't see that yet. So. All right, Ramsey.
Yeah,
Okay.
I'm just gonna asking because I'm in that, I'm in real estate and mortgage, and I see the bank still kind of holding off.
They are. They're not doing any
lending as
yeah, which is, it's awful. But they are. So you're not getting any what they call it, the mortgage. They're not processing them because of the fear.
Yeah.
And that's like defeating the whole purpose of banking. So
the new program that they initiated on Friday, the PPP,
they're
waiting because that's money coming out of them. They need that money.
Yeah. True.
Money,
true.
They're gonna have to pay attention to that.
True. No, I agree.
Out of the bank, I don't know. So these are the things that kind of like still, maybe sit on the pipeline for now with banks until we see more.
Yeah.
Backup from the government, I think.
Yeah. All right. Great. Okay.
Thank you.
All right.
Thank you,
Thank you, Ramin. And
thank you so much.
Yeah, just as a reminder to everyone, please see the chat section. I have reposted the link of the Eventbrite. Please go there. This session is recorded. Once I get the link up about this recording, I will also share on the Eventbrite. And also, Ramin, if you want to share your slides or other announcements, we can use that platform.
That's brilliant. I will.
Yeah.
All right. Yeah, we'll do. I'm gonna try to get our slides in a PDF form if you're interested, and we'll go ahead and I will send it as Sean mentioned. All right. Thank you so much. Have a great rest of your weekend. It was a joy being with you. Thank you.
Thank you, Ramin.
Thank you. Thank you very much.
Thank you.
Thank you, Ramin John. Bye.
Oh, Jana, bye.
Bye.
Bye.